Major private banks that released their first quarter earnings, from margin pressures to muted loan growth and the surprising role of other income as well. There's a lot to unpack here, but before we get Pranav Gundlapale, in fact, let's also take a look at the entire picture when it comes to private banks then.
So thanks so much for that, Shreyansi. Let me first start off with the key themes that have played out for private sector banks in Q1 FY26. First, and as expected, margins obviously have come off. There is a clear visible margin pressure which is being seen. The second piece is with regard to loan growth, and that is patchy. Some banks have done okay on the loan growth front, some haven't, but largely it's been a muted kind of a loan growth performance, especially from the larger private sector banks. And thirdly, other income has actually aided 2 out of the 3 private sector banks, and of course with HDFC there was a huge one-off which kind of aided other income as well. So other income is the factor which has played out on numbers to a certain extent. So let's start by diving straight in. You look at the margin number for an Axis, for an HDFC, for an ICICI. Please keep that base number in mind, because that gives you perspective on what the base margin number essentially was. From there, we've seen a margin shrink. Within these 3, ICICI Bank being the clear winner, because 7 bips of margin compression is not a very big deal for a quarter like this for an ICICI. Let's talk about NPA ratios as well. Again, here you'll see ICICI Bank really stand out with regard to your NPA ratios. Can you pull back one, please? And the NPA ratio reflects that it's absolutely flat. You're seeing a certain inch up in HDFC, but that's because of Agri. But Axis seeing that 30 basis point inch up, that doesn't look too good. And you look at the loan growth, we did speak about how muted it has been. 1.7 for ICICI sequential, just 0.4 for HDFC, 1.8 for Axis. That's where Axis is likely standing out by just a wee bit. Now let's talk a little bit more. Let's talk about asset quality. Look at the way in which credit costs have moved up. You've seen how Axis Bank saw 100 bip move up. HDFC, because they've done those 9,000 crore of provisions, that's what's reflecting on the credit cost number. But ICICI largely is flattish where the credit cost number is concerned. Even where gross slippages are concerned, you're seeing that kind of a very similar trajectory where Axis is the most impacted. ICICI the second most off a low base. That is something to be kept in mind here for ICICI. HDFC relatively okay, Agri being the push. And therefore, what you're seeing is some bit of margin compression across the board. ICICI has seen an 8 bip margin compression, flat for HDFC, so that's the one positive. And Axis has seen a large margin compression. So that's how it's really playing out. In terms of key takeaways from the management call as well, there's been a change in providing for bad loans for Axis. You're also seeing Axis where the margins are expected to further fall from the 3.8% mark. For an ICICI, you did see for an HDFC, you saw floating provision of around 9,000 crore being created. So that was the big one. Confident of growing at industry level in FY26, says HDFC. This is where all the analysts are keeping their eye out on. Can HDFC do this? Last off, on an ICICI, full impact of the 50 basis points repo on NIM to happen in Q2 FY26. So we will see some bit of NIM compression in Q2, and credit costs have normalized. This is where they expect credit costs to be steady state.